Good day, everybody. This is Judd at White Wave Trading. Today we have a special guest, Ira Harris, who we're going to have discuss the alchemy of a trade for the CME trading competition. We have the usual White Wave Judd's Room members. And Ira, I'll let you take over.
Okay, well, I know we've done this before. Is everybody here in school? Is that how you're allowed to, I just brief me really quickly so I know how I'm going to talk to this.
Yeah, I'll do that. The competition, everybody is in a university. This year's there's close to 600 teams
Okay.
competing, universities, probably at least 35, 40 different universities and countries are involved in it. And each team has 3 to 5 students. We do separate whether they're undergraduate or graduate, though the rankings include both. So that's an overview. They have to make 10 trades a day because we want to make sure they get the experience. When I say 10 trades, 10 contracts, can be in, out, whatever.
Okay. All right. I got it. All right.
Okay.
So I'll start with a joke from when I was in graduate school. For the undergraduates, good morning. For the graduate students, good morning. Write it down, right? That was the difference between an undergraduate and a graduate. Sorry, it's an esoteric joke. All right, so I'm going to walk through the way that I look at things and explain to you that there's no one way to trade, because we're not talking investment here. We're talking about trading, right? And to me, there is a big difference, because the way I invest versus the way I trade the goal is the same, but the tactics and operations are far different, although they all proceed from the same analysis. But one is more time sensitive and the other has a greater time horizon. And the reason that you can have a greater time horizon with investment is because when I invest, my leverage is minimal. When I trade futures, by futures definition, the way the system is set up, I have phenomenal amounts of leverage. So that amount of leverage changes my time thought. Now, that's not true for everybody, because some of the best traders in my lifetime, and I'm in my 70s, people like Stan Druckenmiller, and I believe we're the same age, I think they have a longer time horizon on their trades, but I could be wrong with that. But that's just the way it seems. So, I mean, I could sit in a trade, like right now, I've had a trade on for about 5 weeks, which is exceptionally long for me, but it's a yield curve trade. And that takes longer to play out. And the leverage that I use there, because it is correlated spreads, the risk the risk through leverage is less. So I can play a longer time horizon. Does that make sense?
Which curve have you been trading out, or the 210 or the 5?
No,
230?
I actually got out of the 210 really well when it went up, from the August 5th, when it went up to, I think, +8, even though we've certainly been higher than that. But I rolled it down to the 2.5, thinking that the belly, the 5, was overpriced. So I've been playing in there. It's been really good so I'm sitting in here. It's still working. It's working pretty well from when I originally put it on, but it's slowed down here. The 5 is still attractive for some reason, but I thought the 2.5 that the 5 was rich relative to, in fact, all the other parts of the curve. So I've been involved in that, but that's a very long period of time for me. But again, it's because of the nature of the trade. There is less leverage, less volatility. Although in these markets, yeah, I should probably not say that because the volatility factors are now, I don't care what the VIX says. I'm looking at overall market volatility. In case you just don't want to see it, look at Thursday, Friday in the silver.
Oh, jeez.
I've been playing the long silver side against the gold. I took out a nice chunk, but I left a lot on the table because I respect the volatility. They've been beating up silver. Silver's been the weak link for so long, and it was always a late sell-off. So I said, you know what, this has been pretty good. Now you see it. I mean, it's follow through. It was already almost up there. It was over $34 on Friday. So a lot of this move was already into the market.
Well, yeah, and it's got a 35. It wants to go to 35 here to the 618 of this whole swing.
Okay. All right. So in looking at this, so when you're putting together trades, now, if you're strictly technically oriented, meaning charts, you have a different way of doing things. I don't start with charts, and I think that's why Judd wanted me in here. I do global macro top-down analysis. And most of that over my years of doing this, but even when I was in graduate school, I was very fortunate to be in a very good, my work was focused on multinational corporations, therefore foreign currencies. And this was right after the breakdown of Bretton Woods. So there was a lot of things to be looked at. And I was able to have some great professors and who walked me through and taught me, therefore, when I went from the currency markets to the global bond markets. So my world starts with flows of money all over the world. And then I try to put together a picture and I go, well, let's see. And my underlying fundamental analysis is why are these money flows taking place? So once I put that type of picture together, or there is no picture, and that's a story too. But a lot of times that top-down analysis will lead to equity trades, even though that's not my expertise. But I'm a top-down picker. I'll look at a view and I'll go, I like this, I like that. I think this is starting to happen. China's a growth story. Okay, so where can I go there without necessarily being in China? Those are the types of things I look at, and those are the things I'll come to. So again, it's the fundamentals. And then I come to the charts either for breakout points, but most importantly, and it's the most important thing I ever learned is how to manage my risk. Because when I make my worst trades, I don't have good risk points. Because as a trader, my objective is to limit my risk on any trade that I put on. Because I always want to live to fight another day, another hour. Because you're wrong a lot. You're right. There is no perfect timing in this. So again, then it's your risk parameters. So as a professional, my great advantage over the non-professionals for so many years, it's not true anymore, was my cost of commissions. So that allowed me to take very small losses and always be able to get back into a trade if it was starting to take place. And that was no small advantage, but that advantage has been gone for quite a while. Because the commission structure is really, you can go find a clearinghouse, clearing merchant who will, you can get your commissions down pretty low, so much so that they're not prohibitive to getting in and out of trades. I'm telling you, I can go back to years when if you were a retail investor, you were paying $40, $45, $50 a round turn.
Well, that was in the commodities and $80 in the stocks.
Yeah, yeah, well, the stocks were expensive, right, for 100, so they discovered that lower commissions begot greater liquidity and volume, which is critical to it. And what they made up, what they forego in higher commissions, they made up gargantuan amounts in volume.
And let me just make one point here, Ira, that people should understand that Ira's not clicking the mouse off a 5-minute chart. He's looking at longer time frames for his trading. So if he gets out and he wants to get back in, it's not that he's going to do it every 5 seconds.
No, in
Yeah.
fact, I'll tell you that the more I trade, the worse I trade. And that wasn't the case, when you come off as a floor trader, although, Judd will tell you, my floor trading abilities, I was a much better order filler, which kept me busy rather than a scalper or a short-term trader like that, because I was always thinking in these bigger terms, and I used the floor at times to get great price advantage, which disappeared for me so many years ago, because once the electronic took over, that's not where my edge is. My edge has to be in my patience and my ability to act when I want to act and wait for the trade more than trying to push my way into a trade. So that was a very long learning curve, especially for anybody who came off the floor. Most people could not adapt to that.
It was a brutal transition.
Yeah,
And,
it was.
when we started, the bid offer in the currencies were 80 ticks, 80 pips. So if you wanted to make a trade, you better be really right.
Yeah, yeah, yeah. So, but with the electronic, I could never outspeed the high frequency traders, and I learned that because I tried to, and I got, I can't do this. And they have and then as it gotten more advanced, these algorithms drive a lot of the trading, but I've learned how to use in some fashion the algorithms to my advantage, because a lot of times they'll run price and momentum without any sense of fundamentals. A lot of these algorithms, and I'm not a programmer. I know nothing about programming. I mean, some rudiments they've tried to teach me over the years. I stay to what I do, just like I don't do, I can read charts and do technicals, but I don't really do my own technical. I haven't in years, because it just eats up too much of my time. I would rather engross and engage in doing the way that I look at the world, because I always want to read one more thing, absorb one more thing. What am I missing here? And I'll tell you this, the first thing that I always do every morning is I'll go to places and read things I know I'm in fundamental disagreement with, because I learn more from those who I disagree than those who I agree with. So I like to see, what am I missing? What did I miss here? Why am I seeing this? What are they looking at here? So I view that, and I'm not just saying to read anybody. I mean, in today's social media world, there's so many idiots out there writing whatever the hell they think with no accountability or anything. I mean, I go to well-recognized sources where I will have, not that I'm always in disagreement, but I know that they'll have a different view, especially some of the work that comes out of the bigger houses, like out of Bank of America or Merrill Lynch, or especially Goldman, because the stuff that they put out there, yeah, I mean, it's well researched, but you have to wonder who it's for. But I like to read it, and I read I don't have a Bloomberg machine, but I subscribe to Bloomberg's non-trading system, so I get delayed stories, and I read, of course. I don't watch I don't watch where I used to watch. Well, I did a lot of commentary on television, but I don't watch CNBC unless there's something coming out that I think it'll get me, that I want to watch, and maybe they have a couple of commentators on who I'll listen to. but for the most part, I stay away from it because it's just so much noise. I can't listen to it.
I mean,
But
So
I
Miss-
am on the computer all day, digging out stories. There's a group who I do some advising to, so I'm on Slack with them, and they post really high quality stuff. So I'm always have access to a lot of credible sources, and I read them, and then I will take I'll do my work, and I'll look for trades within there. I trade a lot of currencies. The currency trade has been very, very difficult, and a lot of people will stay away from them. But even if I'm not trading them, the currencies will tell a story. And Judd and everybody else who's in this room will verify it. We were on top of the unwind of the yen carry trade, really right from the beginning, because we saw it. Judd did some really good work on the Mexican peso yen, which was a big part of the carry trade. And if you have questions about these as to what they really mean and the in-depth of them, because when those carry trades unwound, it created a lot of opportunities, of trading opportunities, because so much of the world was leveraged up on yen borrowing. And when the yen started to rally, those trades got to be unwound, and you saw all types of ancillary opportunities. And those are things that I look for.
And the one takeaway you should get from this is that everybody's got a little different style. Like, I'm on the Sergeant Schultz method. I know nothing. So I just look at the charts and the currencies and the bond markets to tell me if something's starting to turn.
So I'm Mr. Harris, Andrew Perry here. I have a question for you.
Oh, I didn't know you were university. Yes, go ahead, sir.
I'm kind of because it's intriguing because we all traded differently. I think what Judd has said then. I mean, things change, but
You have to play to your strengths, is what we're saying.
But equally, I think one of the things that really matters a lot is that you got to find this edge that resides within you. Risk management is the most important part of staying alive, because fundamentally, if you can marry the fundamentals with the technicals, you become very dangerous. But you also must marry your capacity to know when you're wrong.
Well, Andrew, you bring up a really good point. And as a good friend of mine, Norb says, and it comes out of what's his name, who was really, he was like he's really well known. I'll come up with his name in a minute because I read a lot of his stuff. But he was a psychologist who a lot of his clients were traders.
Yeah.
I'll ask Norb right now. Hold on. But his view was to whatever you believe your edge is in the markets, work your edge. So if you have deep fundamental knowledge and it's borne fruit and you have a very good comfortable place with it, work that as your edge. If you're really good at technicals and analyzing Fibonacci's, and that's your edge, work your edge. But it's always be mindful of your risk factors.
Yeah, know when you're wrong.
Yeah. I mean, Ira comes into a trade he's got to have a fundamental idea or a reason why he's looking to do something. And for me, my edge is different. And I'm just looking at risk reward and where I think you're going to get price rejection. And then I listen to the news and I follow a lot of the articles to get a sense of sentiment direction if I want to stay with it. So it's just, it's all based on the individual and how you view the world. And
I'd probably add to that if I give I guess all I can do is give my life experience. So, I worked through a bank world as a currency trader, met Ira when I was a young kid through being taught by one of the best technicians in the world that's not known. But so that was my edge, because currencies were different, but in those days, because they were, it was much more a volatile period, and monetary policy was more powerful.
And Andrew, to that point, people aren't capable of doing the currency work correctly to not get blown away when they're trying to do a currency trade.
Currency traders are very good disciplined traders, because they know when to get out. I guess my point is that marrying the different disciplines to be better and knowing where your strength resides. I mean, ultimately, and then building your strengths from there. I mean, there is such a capacity to understand that you don't know. I mean, look, I'm not pretending that you can't be the best technician, because you can't be. I mean, the technicals are no longer the greatest strength anymore. They still reside that way, but if you want to do the work, the market's moving a lot more faster in terms of social media, so forth. But I mean, everyone's focused on the US election and not the Japanese election. Now, the Japanese election, there's information out there about that. I mean, there's so much to learn.
Oh, so what they told you is right. So yes, so you use your technicals. Now, I know a guy who's a brilliant energy guy, and brilliant. He's got he's close to my age. He's about 8 years younger, and he's retired. And he worked for a large global energy corporation for years. He's an engineer, and he likes to look at things, but he says, I never look at charts. And we've just had this conversation within 2 weeks, because he's really just starting to pick up on this, because he wants to know about finance. So we live in the same community, so I've been talking to him quite a bit. But I said, no, you have to learn about charts. If you're going to do this, you have to learn about the technicals. So I said, let me give you a book from somebody who speaks your language. So I gave him one of my favorite, Andrew Lo. And Andrew Lo, an MIT economist and more, who believes in technicals, and he wrote a book, The Heretics of Finance. So I gave this guy, Al, my copy. He says, I owe you, I saw him in the health club the other day. He says, I owe you your book back. I said, take your time, you need it. And it's a guy with all kinds of advanced degrees from great universities. He says, yeah, it's fascinating. That's right, because it's not ways in which you think, but price patterns are important for momentum move. There's all types of things. If you open up your mind, you'll find out how a lot of this stuff works together, and that there's not one of anything. People get bored with me because, again, I'm a top-down man. I'm what they have termed about 25 years ago, a global macro discretionary trader. How's that for a mouthful? But when somebody called me that, I said, I take that as a great compliment, because that means, first of all, I'm not set on anything. As a guy who writes a Sunday piece, Eric Peters from One River Finance in Connecticut, and he had a great line a few months ago. He says, the smartest people I know, and he says, I talked to a lot of them. Yeah, Eric is very accomplished. And he said, they change their mind
all the time.
mid-sentence.
I
Now,
mean,
I'm sorry.
Before you finish that sentence, and I lost my train of thought before. I mean, Stan Druckenmiller and Paul Jones, they, and most of you would have heard of those, right? They'll say things, you hear it in the media. They've already out of their positions that they've talked about. I mean, the ideas that they speak about are very, because they've already made their money and otherwise and built amazing businesses and great cultures, and they still believe in their positions, but by the time they're on TV, they're not still short. I mean, or still long. And Jones was a very different trader to Druckenmiller. Druckenmiller was very much a different investor to Jones, but they talk through a lens of the position that you hear about in the media, everyone jumps on it in a second. They're already out of positions. Would you agree, Ira?
Yeah, but Tony Zing, is
Yeah,
that?
it's a good
Tony-
question.
Yeah, Tony, voice your question so everybody can hear it.
Yeah, do you have a
Yeah, he just unmuted himself. I
okay,
see.
go ahead.
Hello, gentlemen. Really great to be here. I got a question. I'm a current student in University of Chicago, but sometimes when I trading, maybe for the fundamental analysis, I realize for the news they have some negative news for the firms, but at the same time maybe for the technical side, so I find maybe they were oversold. So sometimes I just curious why that same time to be happen. So that's my question. Like maybe you're a professional, so you can.
All right.
I've got a view on it, and I'm sure Ira does, but my view is that, and then I'll let Ira talk, is that the technicals turn before the story in general.
Well, I would probably disagree with that a little bit because,
Okay.
if I'm doing my work well, I'll see things that I think, and Tony, this is a very important word, ought to happen. Now, ought doesn't mean it's going to happen, right? So it's like right now, and the market fundamentals, it's not that the fundamentals change, but it's what the market relies on. So right now, and you've seen it with the equity markets, where traditionally higher interest rates would and when I speak of higher interest rates, there's nominal rates and there's real rates. And Tony, you're from the University of Chicago. We can certainly speak to those terms because so many of the great professors there have excelled at that. In fact, I spent the weekend listening to John Cochran talk about fiscal stimulus and its impact upon prices. So, and he's at Hoover, but he certainly made his reputation at the University of Chicago. But so if I do my work, I ought to see what's starting to develop, because markets don't move for no reason. It could be, so when you look at the world of global finance, a lot of times, and especially in regular markets, interest rate differentials will drive relative values, right? Makes perfect sense. It's like when we talk about the yen carry trade. Why was the Mexican peso yen trade for a couple of years, and Judd could throw the chart up to show you how long it lasted. Why? Well, remember, there were two critical things going on. You were getting reshoring out of China, and where were they going? They were going into the NAFTA component, which was meant at the beginning of NAFTA of 1994, which I can lay out historically, but that's a fundamental analysis, and I'll come back to that. And Mexico had interest rates much higher. And a lot of the carry trade is based on interest rate differentials. Not always, but that's the first thing that global financial people look at is, well, interest, if I can borrow at 1% in Japan and lend at 9% or 10% in Mexico, and things are going pretty good in Mexico, the underlying fundamentals are good, so I'm not worried. And Mexico has real yields of 5, 6, 7%. Well, I'm not worried about the inflation factor. So, you know what? I'm gonna buy peso and I'm gonna finance it with yen, because that's all the carry trade is where you're gonna finance it. And it worked. Judd, do you have the where am I looking at?
If I can add to that,
Wait. Let me just finish with it. So now,
Sorry,
the money's,
excuse me, am I on the right page? Because my screens don't light up to show me what page I'm on.
oh, I'm just not seeing the
Oh.
chart. So
Stan, am I on the right page?
No, you're on the pattern recognition page.
Well, great. Okay, Now, am I on the right page now? I got a lot of screens.
That's
here.
it.
Sorry.
That's it.
Okay, am I there now?
Yes.
Okay. Go ahead, Ira, sorry.
okay, so with knowing that, okay, and knowing the things that are moving around, I go, and you could see it before the momentum, because what Tony, a lot of times what you're seeing, the charts will reflect to you when the momentum starts to build into the trade, right? Or there might be political pushback, meaning that the Mexicans don't want the peso to appreciate, so they'll put pressure on it. And we see that, well, we've seen it with the Chinese yuan, supposedly. I'm not sure that that's the case, because everybody was looking for the yuan to weaken dramatically, but it really hasn't, because I thought but that's, again, I don't want to get off on that tangent. So if I do my analysis and I see these things coming, because I always try to, as Judd will tell you, and one of the good things about technicals, because we have a saying, if you're right at the wrong time, you're wrong, especially if you're using a lot of leverage, right? That's what we're talking about with risk management, because it might take a while for the trade to develop. Now, so when you look at the technicals, you may want to wait for those breakout periods. Now, as far as the fundamentals, when you bring up headlines, right? When the markets react, I don't necessarily, my fundamental analysis will tell me from when data is coming out, when employment numbers are coming out, when inflation data is coming out. I'll do a lot of fundamental work to prepare myself for what the market consensus appears to be, and where are the best sources for it, and who's putting this out. So that way, if the number comes out at a high degree of differentiation from what the consensus was, then it'll give me a pretty good handle about where I might be able to enter the market, because I'll explain something to you about the algorithms. This is from my opinion, but I'll look for levels. So if here, perfect example, and it may be to buy or sell. So if the unemployment number comes out, quote unquote, hot, much better than expected, and you can go look at these. And so what will happen? Of course, the bonds will get hit, the metals will get hit, the dollar will rally. But the technicals will tell me if there's any sustenance to it, or it's just the headlines driving it, and the algorithms are feeding off those headlines. And will that price movement, that dramatic price movement in a very short time, give me an opportunity, a much better valuation to get into a fundamental trade I'm looking for? Are you following that, Tony?
Yeah, I'm following. Is there like a possibility, like maybe for the fundamental side? What I find recently the yuan is
Yeah.
maybe oversold. So I realize they have a higher chance to maybe have a huge back, like a huge down. So I will maybe open my tradings for following the technicals, like a signal or some other thing. So I have a higher chance to win. So is it like that?
Yeah. No, yeah. Oh, but see, I am not a contra trader, meaning that if everybody's long, I want to be short. Or if the technicals tell me that a market has gotten oversold or has gotten to a level where I think, well, this has to hold. I'll give you a perfect case right now. I've been watching and trading off of for a week and a half. The 163.53 in the euro yen cross. That was a big number going back to August, or maybe I'm not on the chart right now. I'm just,
Well, I'm on it.
okay. So that you could see the ceiling that's built in there, right? It gets up there. And a lot of this is based on the Japanese elections because there's some uncertainty, especially with Ishiba and what could take place. Now, a lot of the unwinding that took place in the carry trade was that people were getting nervous about being short the yen because in July, the Japanese politician, it was Kishida was not going to run, and now people were vying for the position, and it was broken down between more hawks on monetary policy and interest rates than versus doves, because a lot of the middle class in Japan has been complaining, this is an unusual event, about the weak yen and the impact it has on prices. This has been part, so there was talk about trying to raise the level of the yen. So this all plays into it. Now we have elections coming Sunday. I believe it's October 27th. Now, if Ishiba wins, I think he's kind of walked back from his more hawkish stance. I'm watching this closely. This is one of those fundamentals. But I still think and I've believed this for over a year. This is a trade I've been looking at for quite a long time. And I lost a little bit of money while trading it, but the technicals kept me out of trouble. Again, I minimized my risk. Even though I saw this coming, the yen was far too weak, especially against the euro, against the Swiss franc, and I wasn't sure whether it was being done to reshore some manufacturing out of China back to Japan, especially in the semiconductors, in the chips business, which had moved totally into China when the yen was really strong. But now that we've dealt with a weak yen, maybe it was time to start changing. So I was paying attention to it, because if you ask me, the underlying fundamentals of Japan are on a relative basis. Again, everything in global finance is a relative basis, because if I can find greater opportunities somewhere else, then that's a better relative trade. And if I'm shunning that, if I'm shunning high interest rates and I'm shunning a growth story, meaning not just me, but the global investing community, that's a fundamental I pay attention to. Why is this shift taking place? Not everything happens dramatically. Not everything is an avalanche. Not everything is a volcano. There are movements afoot, and sometimes the technicals, I believe, are a little slow to pick them up, but I'm starting to see them. So that's what I look for. And I don't just trade as a contrarian. In fact, I never trade as a contrarian.
Let me just add something to what you said before, Ira, because it's important.
Sure.
When you were talking about, you were taking the unemployment as an example. When the bonds broke, the gold broke, because it was all algo driven. But you look at a gold bond spread, and the gold has just gone straight up. So, and we talked about that before, that the gold was not reacting to higher rates. It was just shrugging it off. So.
Yeah, again, another one of those great indicators, right? Because we've put these together over time, and they all have validity. I mean, you can't see it, but I have 101, 2, 3. I want to say I can tell you 1, 2, 3, 4, 5, 6, 7, 8, 9. I probably have 2, 4, 6, 8, 10, 12, 14, 16, 18, 20. I have 188 variables up on my screen. Now, a lot of them are redundant, but they all are lined up. Some are commodities, some are global bonds, some are, a lot of them are currencies, all types of currencies, equities, individual stocks, but they're there for a reason. And when I look and grab my global perspective and money moving, these are the things that tell me how money is moving and where it's possibly going to, and where it doesn't mean that I don't miss things. Of course I miss things. And a lot of people will say, you overdo it. I've been told this for 40 years. You're overthinking it. Well, this is what I think is my edge and my comfort zone. So again, as Judd said, I'm not a 5-minute trader. I mean, I will trade if I see I'm wrong, if I put a trade on, yes, but I don't sit here and try to trade for ticks. I couldn't do it in the pits, and I certainly can't do it on the screen. So that's not where my edge is, but I'm watching all these things, and it tells me money flows. And that's, again, individual stocks, because if I do my analysis right, I will find my way to a lot of individual stocks. And I've been in Judd's room, and one of the better ones, based on what we saw coming with the reshoring out of China, was a railroad, Kansas Southern, which got bought out. But
Oh, yeah, that was an unbelievable deal on your part.
we were buying it at $80, $85, and I was writing a blog, and I kept challenging Buffett. I go, why aren't you buying this stock? Why aren't you? And it eventually got bought out by Canadian Pacific for $320. And it kept going up and up. Now, did I make the whole trade? No. I doubled it, and I said, well, this is how much higher can it go? But it had a lot more to it. But it was a good trade that spun out of the fundamentals. I'll tell you something else, that a lot of times currencies, they may not be the trade themselves, but they'll tell you when something is going on. Classic case was the Chinese yuan during COVID. Every analyst that the newspapers reported on was talking about, well, the Chinese would depreciate the yuan, the renminbi would, in order to protect their market share, right? But the yuan was rallying. And I'm going, this is kind of interesting. I think we went from 7.
Yeah, am I on the right page, guys? You see the yuan?
Yeah, you could see it. Go ahead. You could see it.
Right here.
Yeah, that's the high.
Yeah.
Well, let's go back during COVID. When COVID started in 2020, the yuan was up to 7.1.
Yeah, right there.
And then we came all the way down to 6.2 in the middle of it. 6.1.
Yeah.
6.2. So, which had everybody off guard, but that told me something else. What's going on here? Well, as commodity prices were dropping because everybody was convinced we were going into a global depression, the Chinese kept the currency strong. So what were they doing? They were buying all the commodities in the world, copper, steel, and stockpiling. They were using a stronger currency to take advantage of lower prices, and they were able to stockpile a whole lot of goods. In fact, in 2022, 2023, they were auctioning off the stockpiles to Chinese corporations, to Chinese manufacturing concerns.
That's copper you want right here, Ira.
Yeah. And so, I mean, so that was there. So what did we do? We use that, and anybody listen to me. We bought grain we bought Bunge Grain, we bought Archer Daniel, we bought mining companies, Freeport, Glencore, And you know what? Those aren't NVIDIA, you know, but I don't look for those types of things. Things that I don't understand, I don't, and valuations that I don't understand, I have a tendency to stay away from or let somebody else invest my money. But things that I do understand in the way the world works, I try to gravitate towards those and look for those opportunities. Because that's what we're talking, as trading and investing, you're just looking for opportunities. And as Buffett always yells about, you know, valuations. You know, if you think you're buying something based on, I'm willing to do these trades or investments based on my understanding of the underlying dynamics. But you know, of course, you know, war could change, and when Russia invaded Ukraine, things changed dramatically. But the overall global picture didn't. So amongst that chaos was a whole lot of opportunity. And what do the Chinese say? That, you know, chaos presents opportunities, the same word. You know, I'm not sure about that. So it's just something you pick up along the way. But amongst that, if the underlying fundamentals are remaining the same, then that's nothing but a great opportunity. You know, that's what others have said. You know, buy on the sound of cannons and sell on the sounds of peace. You know, that's an old, going back hundreds of years. So it's basically saying you look for these opportunities, but if the underlying fundamentals in the work that you've done say, well, this is there regardless, I'm now getting some price confirmation, going back to Tony's question, because the charts will give you confirmation of what you're thinking, or the charts may lead. The chart you may get because somebody is aggressively making a price, and you'll see it. Not only that, but as any good technician will tell you about volume numbers too, that all of a sudden volume starting to pick up. You know, price hasn't exploded yet, but volume is starting to pick up, and you're getting some movement. Now you've gotten a 200-day moving violation. You've gotten a Fibonacci number that's worked. So you have things that correlate to it, and you go, something is going on here. So that's what I'm busy searching for all the time. And a lot of it is just really predicated upon money flows, global money flows.
So you want to take the currencies, you know, look at the commodities denominated in different currencies to see if there's something going on. I mean, we've had great trades in the gold because the gold hadn't started moving yet in dollar terms, but it was blasting off before like an ECB meeting in euro terms.
And I'm glad you're talking about the gold, Judd, because in this room, there's one thing I've tried over how many, 4 or 5 years. I've tried to get people to understand. And Tony, this goes back to you, because if you listen to the pundits, quote unquote, on television, they tell you gold is an inflation phenomenon. Well, I've never believed that, because if you're buying gold on inflation, you're chasing it, and it's probably coming to the end. Gold is of all the precious metals, it's the most money oriented, meaning that it serves as money. It historically has. And it serves as a store of value. So over these last 4 years, when people talk about inflation, I said, no, then how do you explain gold rising prior to that? Before you had the inflation of the COVID period, gold was still performing very well. And then during COVID, and then once the inflation hit, gold was hanging around, but it was still up at 1,800, 1,900, historically very high levels. Silver never got anywhere back to its all-time high of $50, which it made in 1980 and then got close to in 2011, 2012, but never made a new high. But gold was at all-time moving up. And as the Fed started and other banks started to raise interest rates, and gold wasn't breaking, not in the way that it thought, as I've maintained. I've had orders to buy gold because I've just been trading gold. I've not been investing. I've been buying gold stocks kind of following Stanley Druckenmiller, who back in January and February of this year started talking about how he was rolling out of NVIDIA and buying gold stocks. And the gold stocks have been a great disappointment. They're still a disappointment, even though they've had almost an 80% move since earlier in the year. But they've been because they're still companies, and they're ultimately, how are they managed? But they didn't really do well, but the precious metal did well. But yet, by my fundamental analysis, I had orders to buy gold down at 1580 to 1630 in a big way, because I thought, based on my work, that that's where we should get a correction to. But the market wouldn't correct, which is a very telltale sign. Because when the Fed was busy raising rates, and as we've heard for all you economists, R-star and real yields, and I'm a real yield person. So when I see real yields climb to, somewhat their historic average of about 2%, a little over 2%, meaning that inflation was down to 3% and the overnight interest rate was 5.25%, that's a real yield of over 2%, which is usually bad for gold. Because
But
gold
I have a question for you, Ira, right?
Yes.
Real yield used to be R star, but when they brought in QE, TGA plus repo, the world changed.
Well, Andrew, I was going to get there. That's right. And you have to know, how has the world changed? What has changed here? And that's why I'm always at work. That's why I work 12 to 14 hours a day, because I'm trying to read so much and absorb so much, and then put it into a great crucible of knowledge that I've attained, and see why this is different. So you bring up a great point.
Which is why gold changed, and that's why
gold has changed.
Gold started saying to the world that essentially this whole idea of these monetary policies were these experimental policies were bullshit.
Well, I wouldn't use that phrase. Because a lot of times, that people applaud what the banks did. And the first, I'm not going to get into an in-depth fundamental discussion about this, but just to see, because we agree on it, but what made a difference, and even the central banks can't come to terms with it, because then they would have to accept responsibility for what's going on. Now, people will tell you it's because of the U.S., the ubiquitous use of sanctions, that they sanctioned the Russians, that they sanctioned the Iranians, that they sanctioned the Chinese. So people are moving away from the dollar, where they have less control, to a less non-controlled form of money. Same with Bitcoin, right? Same with Bitcoin. But to me, the gold, first and foremost, and I'm not new to this. You can go back and read my blog that I wrote for 14 years regularly. Every once in a while write it, but I do a lot of podcasts. You can go find them on the FRA, Financial Repression Authority, and I've been on with others, Victor Jones at Tasty Trade, and we talk about this. And gold has been desirable. It's not inflation, it's central bank credibility. And that's what Andrew's saying. And the central banks have tried to control the business cycle, have tried to do various things in experimentations. They're losing their credibility. And central bank credibility is everything in a fiat currency world. Because we're not on a gold standard. We're not on a gold exchange standard. We're not on a commodity. We're not a barter system. We are, every currency, and especially because the US currency is the world's reserve currency for the most part. If the central bank loses its credibility, you have a real problem, which is why they all talk about, transparency and being non-political. Yeah, it's a nice story, but, I would argue right now that the central bank, especially the Fed, has been very political. Not in choosing sides, but they need to sustain the system. And after currencies as my fundamental jumpstart, then comes the global bond markets, because debt, every crisis in the world starts with debt. And I can go back 500 years, 600 years, whatever, wherever you want to go. Go read Rogoff and Reinhardt for the academics. You know what? It's all there. Everything is debt. So I pay attention to debt. And if you want to sustain sovereign debt, you need to have central bank credibility. So that's, to me, why gold, because gold on a classic fundamental has no business being up here with real yields having gone positive. Now, during the height of as they said, QE to infinity, when nobody was certain about where this was going to end, gold rallying up made perfect sense, because we were all skeptical, and it was anticipating, because of that, a massive unleash of inflation. But if you're buying gold once that inflation, and I mean real inflation, I'm not talking 5%, 6%, 7%, as the Fed tried to sell everybody transitory. I'm talking about, what Argentina's been through, what most countries in the world have been through at one time or another. So that is why, because gold has defied where I thought it was going to go. And again, I was wrong. It didn't mean I've traded it from the long side. I just haven't invested except for buying some stocks. And as Judd has showed you, all these gold currency charts, gold is making highs against everyone. So as central banking tends to be uniform, I mean, if you listen to Christine Lagarde's speech, and I pay attention to every one of these speeches, I don't let anybody do it for me. I'll watch the press conference. I'll watch Powell's press conference as much as I hate him. I watch Lagarde's. The others I'll read, because those are the two important ones. The Japanese I pay attention to. I have a good source for all things Japan, so I get good input from there. But the gold is doing it uniformly. This is something we have not seen a lot in my lifetime. The uniformity of this gold rally, and it is against all currencies. So there is skepticism about central banks. Now, that doesn't mean that's today, tomorrow, but the market's telling you there is some concern. And right now, what part of that is, watch what, when the Fed unexpectedly, for some, it was unexpected, a 50 basis point cut. I thought they should have done a July 31st to get out of the election process and be less political, because of the employment situation was definitely changing. And real yields were high enough to warrant doing it, especially in an overly leveraged system. So that really didn't surprise me. But what have bonds done from, what was the date of the Fed meeting? September 18th?
18th, yes.
Huh?
Yes, set 18th, but they first discussed it on the 31st of July.
The 18th was right?
Yes.
Yeah, I have my calendar. Hold on. September 17th, 18th. So look at what the bonds have done since the 18th, right? Conventional wisdom, yields should be going lower. Well,
But he first spoke about it on the 31st of July. My last question, because it's is you, Mr. Harris. There's a third dimension here we haven't discussed.
okay.
And that is, how does one's bias influence your trading?
How's what?
One's bias, the way you think about the market, your bias, the mental side of trading, the mental side.
Yeah. That's a good question. So when you say, I have a bias to fundamentals.
I'm talking more the, emotionally, people, because there's trading, there's fundamental, there's technical, there's time frames in trading. Some of the best traders you've met, have made their in half an
Oh,
hour.
yeah, here, the gold trade I mean, and I've caught a big part of it up until the most recent year and a half, but you know, that fundamental I can see, but these fundamentals have really, the way I analyze the market, have kept me off of sizable gold position traders because I was always looking for a much bigger correction. And we've gotten corrections along the way. You can see them. But overall, I thought we were going to get, so that's a bias because my bias towards the importance of real yields kept me from being an aggressive investor in that. And it's kept me off, really, it's kept me on, there's times that I'm short. I mean, I haven't been now, but I would actually play the short side in anticipation of something coming down the pike, especially as there was talk of raising rates.
Yeah.
But my biggest bias, and sometimes it hurts me, not in what it costs me, but in what it prevents me from doing. But that's okay because there are so many trades. There's so many trades. As a very good friend of mine, Paul, who ran a big currency trading room, told me 40 years ago, if you can find the 5 to 10 great trades a year, you'll have an amazing year.
I agree.
So, I mean, have I ever learned that? Oh, I learned it. Have I ever practiced it? Not a chance
Oh,
in the world. But yet, it is.
Well, essentially what you're saying, Ira, is that the greatest challenge of traders is we overtrade.
Yeah, we find them, we just don't stay with them.
Well, here, and you know, so let me give you another example of one that I would see. Wait a minute, is Angelo Gallo? Is he a college student? He looks a little old.
Yeah, he's a college student.
Yeah, he's a college. He's chasing co-eds, maybe. Oh no, sorry, Angelo, I shouldn't pick on you. But one of my classics to teach people is the Euro-Swiss cross, right?
All right, hold on, I got it here. So much stuff, I can't see it. All right,
The Euro-Swiss cross going back to that period between 2014, 2015. See if you can bring that chart. See if you got to do it on a weekly, it'll show better, I think.
okay, hold on. Here it is.
Okay. Go to 14 so we can really see it. Okay. You got, so you see it, right?
Yep. Yeah, there's where they blew out of the.
Okay, yeah, go, right. Go, you got to go to the left, farther, my left. See, okay. So you see all that movement there? You see there's nothing, right? Everybody see that? You see how flat that is? That's
For
on
2
the one,
years.
right in on the 120 line for all that period of time, right? So not only did I write about it in my blog, but I was on Rick Santelli on CNBC in December of 2014. And the week before January 15th, when the Swiss let go of the peg, and Rick, and we talked about this trade. And I said, this is going to blow. It's been going sideways. The Swiss bank is intervening to hold the cross at 120. They did not want the Swiss getting strong against the euro and going through 1.20 euro to a Swiss because it was bad for the Swiss economy. But they were spending way too much money to hold it. So I was very adamant on Santelli. This trade's going to go. This trade is, they can't hold it. It's too expensive. And you see on January 15th, they pulled the plug. These are classic things that you're looking at. It's the same thing with in 1992, the famous trade of Druckenmiller and Soros on the at that time was the Deutschmark pound trade. Now that wasn't, believe me, I had the trade on too, because anybody who was watching it, and when the Brits had to keep raising interest rates to keep the price where they were supposed to hold it at, it was going to bring the economy into a depression. It was just a matter of when, because you can't do it. Some government policies are just stupid. And when you see them and you see that the market keeps pushing at them, the market's going to win. The market is eventually going to win. So when I love to look at those patterns, when they're just going sideways, 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 and there's a story to them, and when they break out, those are so. This one didn't break out because there was a bank holding it, and that you could have put on in options. Or I'm sad to tell you, I made more money being short the Swiss on the 2-day rally than I made being long the Swiss. Because again, I could see it was coming. It was going to be timing it. But some people I did advise caught it big time and and we're still in it. We still have a long relationship because of it, because it was a very profitable, and they could see what I was talking about, and they had the trade on in a very nice fashion. So these are the things that I look at. And the fundamentals told you, when somebody is trying to do something to hold the market and the market keeps coming back at it, I just don't think so. And I'm working on one now. And right now I'm wrong as wrong can be, but I'm looking at the soybean market. And the US soybeans are really cheap. How do I know that they're cheap? Because Argentina has said that they've been buying US soybeans because Argentina of all places, but Argentina crushes a lot of soybeans, which breaks it down to oil and especially to meal, which is an animal feed that they ship to all the world. They're buying beans from the US, even though they're a big grower. And there's drought in South America, pretty severe drought. They had some rain last week. So I'm watching this because I'm thinking that there's going to be a play here, because especially the Chinese are always in the market for food. But right now, the US crop is so big, and we're coming into what's called the new crop to harvest, September beans, which is the lead month, which it won't be next week. This is the last week, because that next week starts delivery in the soybeans. So I'm just watching this very carefully, and I've traded it long and short.
It's a good spot, Ira, against the real.
Well, we haven't even gotten to that concept of it. But if you go back, when I first talked about this trade, when the Argentinians announced, we got a nice 60, 70 cent rally off that bottom. And especially, nothing's really developed here yet, but I'm watching it closely because the fundamentals are pointing to it, but price has been weighed down, number one, by a lot of short sellers, and the fact that the US crop has been so big that it's overcome everything. But it's something that I'm watching. I'm not telling you to go out and buy it, not in any way, shape, or form, but it's something to be aware of. And if you do your technicals and say, well, if it breaks out over here, or we hold support here and I can buy it on what I consider to be a very low risk play, I would be looking at. So those are things that I look at. And therefore, the ag stocks have not been performing very well. Bunge got hit on poor earnings on Friday. I mean, they beat it up. So now I own Bunge stock, and I've owned it for a long time, and I've done well with it. But when I say I own a stock, believe me, I've gotten out of at least 50% of it because it's had some pretty big moves. So now I'm looking at, do I want to accumulate more again? Not ready to yet, but I'm watching. I'm watching very carefully because I see some of the underlying fundamentals that I watch building up here. Now, I think, Judd, that the weak real has hurt the beans as usual.
Here in the US, yeah.
They hurt you because whatever is left in Brazil, the Chinese will be buying because the real is so much weaker, and that makes Brazilian beans cheaper. So, but those are only going to last for if the Brazilian drought really takes hold. That's going to be a bigger part of the problem. So we'll see. But but the real does. I mean, that's why the US beans have been under so much pressure. So, I mean, I'm just trying to take you through the mindset of a crazy individual, but most importantly, again, it's a combination for me, this is my edge of fundamentals with the technicals showing me, as Tony asked early, well, sometimes the charts will lead. Yes, in my estimation, the charts will absolutely lead either by momentum or, and you're not seeing the fundamentals. So that'll just tell me that the speculators are moving in to the price, or especially like when you have hedge markets like grains and like gold, silver, copper, platinum, you have producers who are hedging. If they stop hedging because they sense prices are going higher, so they're not hedging their productivity, you will start to get that early move, Tony, and that's what that'll tell me. And give you
Ira,
a
if
few
your
more...
thought process is crazy, then you can call me insane.
Well, Angelo, I have great respect. I know you are very in depth the way you dig through things, and you understand that, and that's what works for you because you're comfortable with them. And you know what? The best thing is to not take a trade that you say, and it may make money.
Yeah, that I don't understand. Yeah.
I left a lot of money on the table on Friday in the silver, a lot of money. But
And there's gold, silver right there. It showed
yeah,
silver was
and that's
just
what I was trading, and I had,
crazy.
and I knew that 200-day moving average, and now we're through the 200-week, and it kept bouncing up there at around what 84, 80. I mean, there were really good levels, which is why I was putting the trade on and playing with it, because the silver, again, Gartman and I and Angelo talked about it 3 weeks ago on that podcast. So we were on that podcast, and Gartman had he said, "I'm not buying silver. I'm an old man. It's too volatile for me." Boy, was he prescient.
That was kind of funny.
So, but again, you've got to find what works for you, and not be afraid. And then once you get comfortable, you're going to lose. It used to be said, some of the greatest traders I know, if they were right 30% of the time, they made a fortune. Think about that. 30. I know if I'm right 30% of the time, I'm going to have a phenomenal year.
Ira, take a step back for a minute.
Hold on a second. Tony's going to leave, but Tony, thanks. We appreciate you being in. Good luck down there on the south side.
All right, thanks,
Ira,
gentlemen.
Ira, you didn't acquire the knowledge and the skill without doing a lot of hard work.
Oh,
and putting in the time. Arnold Schwarzenegger has a saying, and I'll use his accent: "Do the hard work," because nobody else does the hard work.
right.
Right? And so you have to do it. If you don't, then you're going to miss a lot of things and probably lose a lot of money. But I heard you talking about the central banks a little while ago. I was doing some other stuff, and I want to go back to that for a minute because and it was with respect to R-star. And I think what I'm about to say is important, at least it is to me. And that is that central banks use a lot of sophisticated models, words, and concepts to disguise what they're doing. And the reason they try to disguise it is to keep, the average person from understanding what the heck is really going on. Now, with respect to R-star, this notion that they can have a model to know what R-star is, and by the way, R-star is just a fancy phrase for a super simple concept, and you said it, Ira, it's the overnight rate minus inflation, period. Some people want to use a 2-year yield or whatever it is, okay, fine. But that's all it is. But the central banks don't respect the markets because they develop these models under the assumption that markets are linear. And frankly, inflation is always moving, growth is always moving, and the economy is always moving in one direction or another. And their models that the central banks use don't honor that very important fact. The market always figures it out. There's people that do the hard work, they figure it out. We don't always know, Ira, right? What the effect of certain monetary policies are going to be when other conditions are changing. What's a condition today, Ira, that exists now? You and I are focused on it big time, but it didn't exist 20 years ago or 30 years or 40 years ago. And that is the amount of debt and deficits in combination with interest expense on the US debt. And do we get to a point in time where all of that debt gets difficult to service and pay for because it'll come at the expense of something else or some other things? What might those other things be? Well, you know, you have things like military spending, Social Security benefits, Medicare, Medicaid, right? All of these different things. And this is the dynamic, right, Ira, that is bubbling to the surface today in a way that it never has in the past. And so now we're trying to figure out, you know, how does this issue manifest itself? Does it manifest itself in some crisis type of way, right?
Right. 100. That's it. You uncovered. And I was holding up a paper but it's a speech, and I keep it here from March 20th of this year, given in Frankfurt by Isabel Schnabel, a member of the ECB and a very good economist. And the title of the speech is Rising Star. And I keep it because it's a reminder, because I delve in so deep to this between Irving Fisher and, you know, and I've been reading Minsky more lately, but she has this paragraph, exactly what you say, Angela. Here, it's the 5th paragraph in. Since our star, this is her, and she's a very good economist, is a theoretical construct that is unobservable, and the economy's long-run evolution is surrounded by considerable uncertainty, financial markets often look to the central bank for informing and coordinating their views about real long-term interest rates. So she said, you said exactly what she said in this speech, which you didn't even know, but that's it. So we look for that, and the central banks, I'm not just pointing my finger at the Fed, they all want to believe that they have the ability to ordain the outcomes of this. And she comes clean. That's why I keep that speech, because she comes clean and admits it's a theoretical construct that we're all dependent upon. And, you know, they're almost like doctors, you know, do no harm, but they've gone way beyond that, because in their
They've gone way beyond. And Ira, that was my next point, is that the credibility of the central banks rests on one thing, and I think one thing only, and that is maintaining the confidence of the populace and the politicians. So how do they do it? They construct all of this fancy schmancy stuff to give everyone the illusion that they're smarter than everybody else.
Yeah. Well,
and it's that if we ever get to a point where markets lose confidence in central banks, and I believe that's why, you know, the metals are doing what they're doing, right? Against all currencies, not just the United States, it's everywhere. Right? If it was just the United States, then, you know, the dollar would collapse against the metals.
Well,
but that's not
to
the
that
case.
point, Angelo, the dollar-denominated gold has never led this move.
nope, not yet.
Now, yeah, and now you're seeing the silver pick up against the currencies, which just has recently started. And so now I have to go back into all those spreads because I haven't done enough work on them yet.
So
And I think not against the dollar, not yet, as the two of you just said. I think that's going to be a delayed reaction because we're in my opinion, we're seeing a new dynamic with respect to the dollar. Dollar's going up because inflation is going to rise and is rising. We've never had that before. And I think a lot of people are off sides with this.
yeah,
It's right, Ira. You and I talked about this the other day. It's a new dynamic
yeah.
that now we have to see how the heck does this play out?
Oh,
Because I'm not so sure yet. I have a couple of thoughts, but I don't really know.
Yeah, you know what? That's right. And Angela, you put it together to me very well. This is where we sit. And again, I'll go back to my comment, which I learned from some of the really great political economists when I studied under them about debt and its power. And it's one of the things that irritates me that nobody is talking about it. Neither Trump nor Harris, nobody can talk about it. And I understand it. If you let me ask the question, I would ask both of them. I said, well, what is the price of gold going up here? But I would ask Powell that at a press conference too, by the way.
Well, the other two can't answer the question.
No, none of them can. Powell would run away from it so fast. Well, it's just, speculate, whatever you're going to lay their heels at. But it's been, as the chart reflects, now we're getting a little more volatility than we have, but it was just a regular, steady flow up. What's going on here? Those are the questions. I don't give a, they're just ridiculous. These are very big questions. And there's nobody sitting in that shit house of Congress who nobody wants to talk about it. And they're all culpable. There's nobody with clean hands. I'm an anti-defense guy. Not that I don't believe in having a strong military. I'm anti-budget, the defense budget, because it pollutes the entire budgeting system. And if you go back to the Bowles-Simpson committee back when Erskine Bowles and Alan Simpson, under the direction of Obama's
They wouldn't take that
administration,
up because it made sense.
they were cutting defense spending 10%. And as they all said, it won't make one impact on the ability of the country to defend itself.
Yeah.
You've got to get into the heart of it, but nobody's dealing with it. And it's not that it can't be done. And it was interesting, 2 years ago, they talked about Powell finding his inner Volcker. That's pure nonsense. I said it was nonsense 2 years ago. It's more nonsense now. There is no inner Volcker. You can't be Paul Volcker in a world with 100% debt to GDP ratio. Cannot be. Paul Volcker could never have been Paul Volcker. He would have crashed the entire system. But the debt to GDP was only 39%. So we had more flexibility to fight the inflation target. But these are all that we're.
All right, so let's get back on topic, Ira, for a second.
Because I only got a few more minutes because then I'm doing.
The conversation's been great for all these people that want to listen to it, to determine how they want to trade. Some of it's individual. Everybody's got a different style. You can, whether you're an options trader, a swing trader, global macro. I mean, I used to be the biggest hamster in the world. I gravitate more towards what Ira and Angelo do now, but I'll go, I become a hamster when I try to pick an area where I think you can buy them before you sell them or sell them before you buy them and see what develops. And especially if like some of the trades that we worked out in this room, some of them took 6 months to play out, but we knew technically where we wanted to look for the turns, and we had timing for those turns, and it turned into some really good trades.
100%. And we do so much work that we see correlations you know, it's like I said, I'm a human algorithm because I've always been looking at these correlations, you know, slowly and manually, and I don't do them automatically. I've never built a neural network. In the 90s, I had a cousin Victor who wanted to do what I do and just put it all on a neural network. But the bill was going to be about 600,000. So I kind of said, no, I'll keep doing it this way. It was probably a great mistake because I should have gotten somebody to underwrite it. Because it probably would work. Now I could do it for nothing, but yeah, I'm too old. I'm never too old. I'm always willing to learn. But here, because I'm going to leave in a few minutes, but here, we're looking at the gold, right?
Right.
Now overlay Newmont, which is the best gold mining company by some standards. Look at what Newmont has done relative to the price of gold. Put up a weekly chart and you'll see.
Dan, what am I doing here on this to get this in? Oh, there it is. Okay.
And so what somebody may say is, well, I'm going to buy the gold stocks because they're cheap relative to the price of gold. That's one way you could look at it.
Stan, why am I not getting this up right? Hang on a second.
It might be the scale. So go to the right, go to the scale on the right and go share scale. No, you don't want to share scale. You don't want same scale. So leave that off. It should be there. You just probably the easiest thing is to open up a new chart where you don't have all the studies. And then just put them both up and make one of them red, and you can see exactly what he's saying, because you're not getting both curves up there, even though they're there.
I can,
All right. Well, it says Newmont Weekly.
yeah.
Gold. What am I not doing here? Go ahead, take it away.
Did you put analog on?
Yeah,
Yeah,
Okay.
they're both listed there. Hold on, let me see what they're.
there's a linear. I can put the analog on.
Actually, Judd, while you're doing that, I want to pose a very specific question to what we're doing here to Ira.
Okay.
So Ira, I have always thought that, or believed that gold stocks perform very well when you have a combination of lower inflation costs in combination with central bank.
Oh, it's SDOT.
Wait a minute. Central bank. What the hell is the word we just used? Confidence in central banks. Credibility. So the combination of a lack of central bank credibility and a lower inflation rate is good for the mining stocks. Mining stocks have a difficult time in higher inflation regimes because it's expensive to pull this stuff out of the ground.
Because they're right. So yeah, or they're badly managed. Maybe that's it. But I'm just showing you the difference. That one is on its all-time highs and the other is not close.
Yep, you definitely have to pick them right.
You have to know you. So just to say, because from that perspective, yeah, it's and again on this stuff with central banks and gold, this is not conspiratorial stuff. This is just what the market is showing you. Because again, with interest rates of real yields in a positive mode, gold again, and I use this word exactly as it's meant, ought not to be here, and yet it is.
That's right. And Ira, the correlation dollar to gold has gone from negative over the last 120 days to positive.
Yeah. So they're
so up dollar, up gold.
Yep.
That's not what you normally see.
Nope.
Well, and it's been going on for not the tightness of the correlation, Angelo, but the trend has been going on for a couple of years.
Yeah.
Mm-hmm.
Okay, this is the.
But now the condition set has changed, Judd.
Yeah.
It was.
I'm not disputing.
In other words, the gold correlation used to be negative to the dollar, opposite the dollar. So dollar up, gold down.
Right.
Okay. Now the correlation is positive. That's a totally new dynamic. So dollar up, gold up. Dollar down, gold down.
It means gold's going up with interest rates.
That's right.
The gold bond chart, the gold, long silver, short bonds is, you know, that was at the beginning of the podcast we had up. You know, Andrew's been talking about this for a week or two. It's just insanely exploded.
This is
You know, our bonds is duration weakening because of inflation, which is not so bad right now. It was, but it's not right now. It's, you know, it's leveled off a bit. So are the bonds weakening due to inflation, or are bonds weakening due to the debt and deficit situation here in the US and everywhere else for that matter?
There you go. There's the chart.
yeah.
Yeah. So you,
I
s-
mean,
you-
they're
you-
actually moving up at pretty much the same rate right now, but your point is up here,
yeah,
making all new highs. Up here, we're not even up there. Well, we're getting up there now.
right, right. So value guys will say, well, this is way undervalued. I'm not sure. Well, maybe there's something wrong, you know, and the stock is just is grudgingly and gradually following up, or it'll have a big pop. But if you're going to play the big pop, you better know damn well where you're wrong. That's my only point.
You know, Ira,
Yeah.
when we moved it over here and got rid of the highs, I mean, they're moving up together right now.
Right now. Right. Those are the value people coming. Oh, this is, you know, as long as gold's going up.
Lagging so much. Yeah.
Yeah. But on when you put it contextually, yeah, Mark, this is the last question I'm going to answer, and I go. So that's a good question. And Basel III, by the way, is not etched in stone. You know, there's a lot of controversy over it, and who's going to really adhere to it. You know, I don't know, but it does, but you know, it factors into it, and I have to keep going back to Basel III because its impact is so vast. But it's a good question, and I can't answer it. I can't answer it. But it is a very good question. All right.
Ira, thanks for your time. This
Yeah,
has been
no,
a great
I hope
conversation.
All right.
Thank
Yep.
you very much, Ira. I really appreciate it.
Okay. You know, whatever I could ever do for you, Stan, it's my pleasure. Thanks.
Thank you.
All right.
Judd,
Yes.
I just want to make two little comments. I compare historical volatility of options, and two of the things that just struck my eye as I was looking at them, gold had been for a long time, historical volatility was ahead of implied. And around the end of August into September, we start to see that relationship change. And we've seen implied volatility, whoops, let me get over. The implied volatility continue to rise against the historic volatility. It really capped itself at the beginning of August, came down a little bit, and then is starting back up again.
Is this what I'm looking at here?
Yeah. Just enlarge the chart on the left. Wait a minute. Go to HV20, the first tab on the chart. Yeah, that's the longer historic volatility. Okay, you can see the thing on the bottom, and you can look at the graph on the very bottom. That's when it's green, implied volatility is higher than historic. Those little dots tell you when we're within 10% of the high or the low, but these are all high. And you can start to see the volatility. When I was teaching options, I always said that even if you never trade an option in your life, it's good to watch these volatilities. We're starting to see the same thing along with what Ira and Angelo said. We're starting to see in soybeans, we're now starting to see implied volatility increasing. So the market price may not be showing it yet, but people are buying options. Now, remember, volatility is independent of direction. They're just telling you they're buying options.
Look at this spike right here.
That's right. And that's telling you that there's a lot of buying coming in. We don't really know whether they're calls or puts at these levels. If I had to guess, I would say they're buying more calls. But it could also be farmers buying puts to protect their inventory. But they're buying options. We can see that. Remember, options are insurance policies. So they're buying insurance. And so we were talking about it. So I looked at it, and it just kind of stuck out to me how sometimes the people's opinion is being voiced in buying options. And I think Angelo's become very good at that because he's been following the SPX options and SPY options. And you can see that the puts are always being traded more. Why? Because people can protect a portfolio by buying portfolio insurance puts. And that's why the options, but you always have some people that are also using it to speculate on a move as well. But that's another source of information that gives you an idea of what's in the mind of the traders. That's all.
All right. Well, thanks, Stan. Again, if you guys want to keep following, you're on my distribution list for a month. If you subscribe to my comments, then you'll get a room invite as well after for 30 days after the competition ends. And Stan, thanks for putting this together.
You're welcome. Thank you for hosting it.
All right, guys, I'm going to stop the recording. Okay.